Welcome back to FBS Growth School, where we help you unlock your financial and personal growth potential. In today's session of our Stock Market Mastery course, we're diving into the mechanics of how the stock market works and introducing you to its key players. Let's get started.
How does the stock market work? The stock market might seem like a complex web of transactions, but at its core, it's simple. It's where people buy and sell ownership shares of companies. Let's break it down step by step. The marketplace. The stock market operates like a digital auction house. Buyers place bids, sellers offer stocks, and transactions happen when both agree on a price. Imagine a crowded marketplace where people shout, "I'll buy this for $10," and others reply, "I'll sell it for $11." When they agree, the deal is done. The technology behind it. Today, most of this happens digitally through stock exchanges like the NYSE or New York Stock Exchange, known for big companies like Coca-Cola and Disney. NASDAQ, the tech-heavy exchange, home to giants like Apple, Microsoft, and Tesla. International exchanges. Examples include the Bombay Stock Exchange, BSE, in India, and the London Stock Exchange, LSE. Role of brokers. You can't directly access the stock market. You need a broker, which is like your ticket to the show. Brokers can be full-service brokers like Merrill Lynch, who give advice and handle trades. Discount brokers like Robinhood or Zerodha, which allow you to trade directly online. Key players in the stock market, retail investors, that's you and me, individuals investing to grow our wealth. Retail investors often make decisions based on research, news, or emotions like FOMO, the fear of missing out. Institutional investors. These are big players like mutual funds, pension funds, and hedge funds. They control large sums of money and can influence stock prices significantly with their trades. Example, when Warren Buffett's Berkshire Hathaway buys shares, the stock often rises because others follow his lead. Market makers. Ever wonder who ensures you can always buy or sell a stock? That's the job of market makers. They provide liquidity by buying shares from sellers and selling shares to buyers, ensuring the market runs smoothly.
Regulators. Stock markets are regulated by government agencies to ensure fairness and transparency. Examples. In the US, it's the SEC or Securities and Exchange Commission. In India, it's SEBI, the Securities and Exchange Board of India. They prevent illegal activities like insider trading and fraud.
How are stock prices determined? Stock prices aren't set by the companies themselves. Instead, they're determined by supply and demand in the market. Demand drives prices up. If a company announces a groundbreaking product, investors rush to buy its stock. This increases demand, driving up the price. Supply drives prices down. If investors lose confidence in a company, they start selling its shares, increasing supply and pushing the price down. Factors influencing prices include company performance, such as revenue, profits, and growth projections, economic conditions like interest rates, inflation, and GDP growth, and news and events such as CEO changes, product launches, or global crises. For example, during the COVID-19 pandemic, shares of tech companies like Zoom skyrocketed due to increased demand for remote work tools.
What are the types of orders in the market? When you trade, you don't just buy or sell randomly. You place orders that define your strategy. A market order buys or sells a stock at the current market price. For example, if a stock is trading at $100 and you place a market order, you'll likely get it for around $100. A limit order specifies the price you're willing to pay or accept. For instance, if you place a limit order to buy at $95, the trade will only happen if the stock drops to $95. A stop-loss order automatically sells a stock if it drops below a certain price, protecting you from heavy losses. For example, if you own a stock worth $100 and set a stop loss at $90, it will sell automatically if the price hits $90. Why do stock prices fluctuate daily? Stock prices fluctuate because of constant buying and selling, influenced by news and events like positive or negative developments around a company or the economy. Earnings reports, where if a company beats or misses profit expectations, the stock reacts. And market sentiment, where sometimes prices move based on investor emotions rather than logic. For example, Elon Musk's tweets often cause Tesla's stock to move dramatically within hours. Real-life example of stock market in action. Let's look at Apple. Apple announces a new iPhone. Investors expect high sales, so demand for Apple's stock increases. This pushes the price up as more people want to buy it. Later, if a competitor launches a better product, confidence in Apple might drop, causing the stock price to fall. This constant cycle of confidence and doubt is what keeps the stock market alive and dynamic.
Recap. Today, we explored how the stock market works and met its key players. We also learned how stock prices are determined and the types of orders you can use while trading. By understanding these mechanics, you've taken one step closer to mastering the market.
Thank you for watching today's lesson on FBS Growth School. Tomorrow, we'll dive deeper into the types of stocks and why diversification matters. Don't forget to like, share, and subscribe to Future Business School for more growth videos. Thanks for watching.